So welcome everybody, it's Stuart here from Hot Forex. This is a webinar on correlations both within the Forex market and outside the Forex market. So we'll look at commodities and the bond market, briefly the fixed income market, and also obviously within the Forex market as well. So welcome everybody. As usual, start any questions, please put them in the question box and I'll endeavour to answer them as we go through. So welcome everybody, let's get going. So a bit of admin at the beginning. Any questions I don't answer here, please please email webinars@hotforex.com and me or the team will get back to you as quickly as possible. Any issues with GoToWebinar, which seem to have cleared up recently, please try restarting your end as well. So before we get going, this material is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in Forex and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. So there you go. Excuse me for that rambling on, but that's disclaimer is quite important. Those of you that don't know me, my name's Stuart. I'm one of the market analysts here at Hot Forex. My background is I've done lots of different jobs in my life, but I've always been in and around the City of London, and I work for investment banks and retail banks. But more importantly, for this role here, I've been investing and trading my own money since 1997. September 1997, I got going in earnest, and over that time, I would distill what I've learned into some, key things. Do it if it's probable. Do it. Keep it. Don't overcomplicate it. Keep it simple. Understand multiple time frames, both the lower time frame and the higher time frame on the trading time frame that you're trading on. But most importantly, is to know yourself. This business, in my view, is a psychological business. It's all about understanding yourself. Anybody can learn to read charts and learn technical analysis. Obviously, there's a little bit of maths involved, simple numbers, but it is very, very simple numbers. Think in probabilities, think in percentages, but most importantly, know yourself, accept losing, because there's no other business in the world where you lose as much but can still make money. It's crazy, but that's just what trading's about. It's no other business, no other occupation, job, if you like, where you're on your own a lot. You do a lot. You don't do a lot for a lot of time and still can end up being very profitable. So all about knowing yourself, really, and I can talk in hours about it. Any of you that see my seminars or see me live or watch the other webinars, watch the Mind Games webinar. It's absolutely fundamental, and I hope everybody here has actually watched the Mind Games webinar, either live or watched the recording, because that is absolutely fundamental. Anything I'm going to talk about today is irrelevant if you don't understand yourself and accept that losing is part of this business, and managing your risk is by far the most important thing. Anyway, so financial markets, how they're all linked together. It's all about money flow, especially the big players, the big market makers, the huge hedge funds, the huge governments, the huge banks, the ones we see are all the time, Goldman Sachs, Morgan Stanley, BlackRock, all these big institutions that are moving millions, trillions of dollars, in fact, millions, billions of dollars on a day, trillions of dollars around the world at a push of a button. The bond market and why it's important. We've just introduced trading on bonds. It's a big sector that is largely ignored by lots of Forex traders, but Forex is fundamental because it sits in the middle. Commodities and equities are the other key markets. Obviously the indices is the other one, but the Forex market sits very central, and it feeds and it supplies the money flow that's flowing between particularly the bond market, which is huge, but the Forex market is key, and it's funding obviously commodities, equities, and as you can see at the moment, the money flow is very much into equities. Equities are driving up, bonds are are also in a big bubble as well. So commodities are suffering a wee bit recently, and we'll come on to that. And how that affects Forex currencies is quite important as well. But it's important that you understand the basics, okay? What are the other when I talk about the other financial markets, what they are, and why we need to know what's important with what's going on in them and how it affects us as Forex traders. Okay, so two absolutely fundamental key points. Okay, money flows, cash, whatever it is, press of a button. It's all about asset flows, asset class to asset class. So from Forex, funds most of it, into stocks, commodities, and bonds are the other three key assets. And obviously commodities broke down into energies and lots of others. But that's where all these trades, all these deals have to be funded somehow. And so it's all about money flowing from one asset class to another. And when you hear the market talking about the sentiment is, risk on or risk off, it'll flow from certain types of assets to other types of assets, or other certain types of currencies to other types of currencies. So it's understanding that as the basis. But again, as with anything in the market, nothing is a given and nothing is 100%. So just like when you're looking at your charts and your candle patterns, just because a candle with a great big long wick at the bottom at the end of a downtrend should suggest that the trend is ending, it doesn't always end, but the probability is that the market's ending and we've got a big long wick to the south. It should end. It should mean that perhaps the downtrend is coming to an end. So, but it's not a given, and just like money flows isn't a given. The thing that the fund managers and the big hedge funds, these guys that are dealing with billions and trillions of dollars a day, they're always after yield or return. You hear that talked about all the time, yield and return. So where can they get the best return, risk reward for their cash? Which part of the market? Do we move into EMs or emerging markets as a whole? That's a whole business as well. Higher risk, but the returns are higher. China's growing at 6%. India's growing at 5%. I saw a guy this morning talking about Vietnam. A much smaller market, but growing very quickly as well. But the risks are higher in these areas. Brazil's been a great example of that. It fell apart. Venezuela's falling apart as far as investments are concerned and defaulting. So it's all these big players are all looking for that sort of thing. And we as smaller players, as retail traders, we can still get onto the tailcoats of these big players by watching what they're doing, seeing where their money flow is going, and following them sometimes. If the big money, there's a lot of money moving into Chinese assets, or look at some Chinese equities. You can trade those now. If there's money's moving, as it has done all year, into American equities, look at some of the key equities there, like everybody's heard of the big tech players, and at the moment, typically for December, we're getting a churn out of technology stocks, which have had a really, really good 2017, into more stable banking and telecoms type stocks, because of the tax changes that are coming through in the US is going to benefit those companies more than perhaps the tech stocks. So and again, these big players, these hedge funds and these fund managers, are now banking all their profits on the big run up we've had in Apple and Facebook and Google and on all the other tech stocks, Netflix, this year. So it's all about seeing where the best yield is, the best return, and the flow between these different assets. And Forex itself can help you as well, because the money flows within the Forex market as well, but it's between Forex and the other markets as well. So the original slides, I was looking through these slides. I put them together in originally last year. But nothing's really changed other than this current number here, and some of the charts I'm going to show you in a minute as well haven't really changed, but I've updated some of them as well, obviously. So it's the money flow, as I keep saying. So for the Forex, one of the key things, or the one key benefits of the Forex market, it's too big to be cornered by any one group or any one interest level. So some of the issues with some of the stocks when you see them gapping around, if there's some big players wanting to bid up Google or even some smaller stocks, Apple and what, sorry, some of the even smaller stocks. So even the big stocks can be, the big players can corner some of the markets in there. With Forex, you can't get that, and you've got to understand the basics. Okay, you've got to appreciate, you've got to know this table should be fundamental to you, and as it changes, as the main central bank changes their central interest rate, you should know that. This should be sort of printed off and stood next to your any trading that you do. Okay, you should understand that the Bank of Japan and the Swiss National Bank, they have negative interest rates for their currency. So what does that mean? Well, it means the big players, any deposits you put in Japanese yen or Swiss franc, you have to pay the bank to keep your money there, which is crazy, but that's what's happening. So some of the biggest moves we've seen recently have been with these, they call them interest rate differentials. So the Bank of New Zealand, the Reserve Bank of New Zealand, the Kiwi here, is still offering 1.75% interest rate. So there's a huge difference between that and the Swiss franc, and you'll see throughout 2016 and 2017 the Swiss franc New Zealand dollar pair rallying very, very strongly, and then we got to the spring of 2017, and this pair's now come down as the differential is distant, and New Zealand are talking about cutting their rates as well, like everybody else. So that's what happened. The red ones here are just the central banks that have moved recently. So the Bank of England not so long ago increased interest rates, and so did the Bank of Canada, the Central Bank of Canada. So these are the main central banks. The 7 you really need to know about. The one that isn't here is the PBOC, the People's Bank of China, because still, although China is the world's second largest economy, the renminbi, or the Chinese currency, doesn't freely float like all these other currencies here. These currencies float around at the click of a switch. Although the renminbi, the Chinese currency, is traded, it's controlled quite strongly by the bank. It's by the government itself of China, whereas the central banks of most of these countries here are independent and run independent of governments. Well, all of them run independent. Obviously, the ECB is reporting not just to one government, but to 27 or 28 countries within the euro area. So that makes the ECB's job even more complicated than perhaps some of these other, or certainly more complicated than a lot of these other central bankers. Anyway, that's fundamental to your knowledge, so you've got to have that. That's the basics of the Forex market. Within the Forex market, it's the flow and what the big players are doing. So what you want to know is who are the big players within the Forex market. Okay, and there's 8 major banks controlling the vast majority of Forex funds, and London, that's why the London trading session is the centre of Forex, because London is, although not the centre of any of these, or only one of those banks or 2 of those banks on there has its centre in London. The London financial market is central for Forex, and that's part of the big issues with Brexit and all that. I won't go into that now, but that's sort of that's the part of the huge issues with Brexit is the financial services sector for the UK economy. It's absolutely fundamental and takes a major contributing size of the UK economy. So here, again, if you're following the major central banks, it's good, before you even trade, or even without the small amounts that we trade with, it'd be good to know what these key players here, these banks, think about certain currency pairs, because they publish it quarterly and even more so. So the big players, these major banks, Citibank, JP Morgan, UBS and all the rest of it, this is how much of the centre of the Forex market goes through these 8 institutions. Is that 8 there? 2, 4, 1, 2, 3, 4, 5, 6, 7. Yes, these 8 institutions account for a huge amount. You add all that up, a huge amount of the Forex market. So it's good to know what Citibank think about euro dollar, where they think that's going to go. Not that it should influence your trading on a day-to-day basis, but it's good to know where these guys think certain currencies might be going over the next 3 months, because they're the big players. And then below that, we have these smaller banks, or minor banks I've called them, perhaps banks in your countries, or banks, smaller banks in Europe, smaller banks in Asia and the UK. And then there's big institutions that shift, and hedge funds that shift lots and lots of currency around as well. Obviously fund managers, and then below that is liquidity providers, parts of banks or sections of banks or smaller banks, and then us as retail brokers sit below this lot as well. So it's a huge interconnected, quite straightforward market, to be honest. A lot of misnomers. There's all this perception within the broking industry and Forex and trading industry that it's much more complicated than it is. It's quite straightforward. Obviously, there's a hierarchy, and these are the big guys that sit at the top, and everybody else filters below that. Okay, so Citibank still account for nearly 13% of all Forex deals done, and London through London itself accounts for an awful lot of what's going on. So the correlation is also quite straightforward, and again, I get many questions about what the correlation between currencies. Remember, it's all about, when you're trading currencies, it's all about the pair and the both sides, either side of the trade. So USD JPY, USD CAD, USD Swiss, you would have thought these are positively correlated. So as the dollar increases in strength, these three should be going up. So if they aren't, there might be a particular reason about a particular side of this currency. One of these particular countries might have something significant that it isn't going up, but technically they all should rise and fall as the dollar strengthens and weakens, okay, positively. So they all should be going in the same direction. And the dollar is king. I'm sure all of you know this, but it is absolutely fundamental. Nearly 90% of all FX business, and remember, this global market I've just talked about is over $5 trillion a day. That's 12 zeros after the 5.3 trillion dollars a day. The dollar is involved, and that's why we're so obsessed in the market about watching what's going on politically within the US, economically within the US, because it fundamentally affects 89% of all Forex business that's done. And I guess most of you out there will be trading the dollar at some point. I mean, every trade, most trades I do involve the dollar, and I'm sure that's the case for everybody. So that's a positive correlation. Negative correlation is obviously when the dollar's on the other side of the trade. So against the main eight, it's the other side against Euro, Pound, Aussie, and the New Zealand. So negative correlation. So as the dollar strengthens, this group of currencies should all be falling, and vice versa. As the dollar weakens, all these will rise. So a weak dollar should see the euro-dollar pair start to rise. And again, 63% of all money that's held as cash is held in dollars. 63% of all current global currency reserves in banks, central banks, hedge funds, institutions is held in US dollars. It's a massive impact. The dollar. And again, just to finish it all off, all commodity prices, anything you can think of, from coffee or wheat to sugar to oil to gold, they're all priced in US dollars. That is why we always say, and everybody says, the dollar is king, and it will remain so for some substantial time. There will have to be a major move from either the Chinese freeing up the renminbi or the euro area getting its act together for anything, particularly commodities, to be priced in anything other than the US dollar. So love them or hate them, the Americans are important. Love or hate President Trump, what he says is important. Mr. Powell, the new head of the Fed, is absolutely vital to us as Forex traders. Mrs. Yellen's been absolutely vital. Any member of the Fed speak, is vital to the dollar, is also therefore impacts anything we do. So that's why there's this massive concentration, I say, love them or hate them, about the US and the US dollar, and they're the key currency. So let me just go through some of the key things, or the key correlations and movements. So the euro pound, again, I trade all 40 assets, all the major crosses. So it's 28 of these 7 major currencies. I trade all their crosses. But if you can't do that, or you don't want to do that, you just want to concentrate on a few, well, pick the most liquid, pick the ones that move around the most, because you want volatility, you want movement to give you the opportunity to trade. But each currency cross has its own personality, and the longer you trade them, you will see some trend better than others. The beauty of trading Forex is very liquid, and it's a great trending and it's a great trading asset, much more so than, for instance, stocks. Stocks can jump around a bit more, gap a bit more, so you can, although it's closed at one price on one day, it can open the next day much higher. 90% of the time, 95% of the time, probably 98% of the time, with Forex you don't get that. You get this smooth movement, and it's great for trending, it's great for trading, because it's liquid, it's open 5.5 days a week. That's why Forex is so appealing. But each of the currency pairs has their own profile, has its own personality, so get to know them. The euro dollar there, it's the most liquid, it's traded the most, it's concerning the world's 2 largest economic groups, covers the active trading sessions as well. That's the other thing. The London session, as I said at the beginning, is that's where Forex is based. So the London session, 8 a.m. GMT to 6 a.m. GMT, that's the key trading time. And obviously when the Americans wake up and America wakes, the US session opens, that's it's a really deep liquidity, and that's why euro dollar, pound, the cable, pound dollar are some of the key and most active pairs. So tighter spreads. Many retail traders just trade euro dollar sometimes. The yen, we all talk about yen being the safe haven. The dollar, when in times of worry, the yen rises because it is the funding currency of most big traders. So I've brought here the Bank of Japan, probably the most influential central bank. That's probably not strictly true anymore. It's probably the Swiss National Bank, the SNB. But Bank of Japan, very active in intervention in their currency. So risk off means that you hear in the market means the yen's up. Risk on, the yen slips down. Huge dependency in Japan on exports. So that's why the currency is so fundamentally correlated to the economy of Japan. A very technical pair as well, the dollar yen. You can trade that quite well. So is the euro dollar is less. I find it less technical. It's a bit more. It's less trending, if you like. But dollar yen very technical, simply because remember the Japanese have been trading currencies and trading assets and commodities for many years, and there's a big population of local traders in the yen, and that's a very technical way of trading. That's how the Japanese approach things, a very technical way rather than a fundamental way. The pound or cable is by far probably the most active pair. It tends to have the highest daily range of these top 3 ones here. It covers the busiest session. London, again, as I said, centre of FX, and there's a strong correlation between the cable and the dollar index. But these correlations, they don't last forever. They break down, and sometimes they're more correlated and less correlated over time. So don't really hang your hat on them. Like I said before, nothing is perfect in the world of trading. So very much a backup pair. Again, I know many traders, professionals as well as people trading their own account, that just trade either these two, especially in the UK, just these two, the cable and euro dollar. Just that's all they concentrate on. Many other people obviously trade the main 3, the G3 as they call them: euro, yen, and pound. And look at those 3. The Swiss franc is, whoops, where are we going? Sorry, let's just go down a bit. The Swiss franc is another one that's here. safe haven, just like perhaps less so or less understood than perhaps the yen. The S&P is the Swiss National Bank is very, very interventionist, as I wrote here, just like the Bank of Japan, probably more so than the Bank of Japan. Very strong correlation with yen when there's a risk off, like we had this morning. There's been a bid on the yen and a bid on the Swiss franc because of some of the comments that President Trump made. Gold didn't move, so that correlation didn't happen. What was all that about? It kept going down. It's come back up a bit since then, but certainly the yen and the Swiss franc were the first to move this morning in this the comments from President Trump about moving the US Embassy in Jerusalem, but that's a story for another day. And again, so correlation can be positive or negative, and there tends to be an inverse correlation to euro dollar between dollar Swiss, but again you'd expect that because the dollar here is on this side and here it's this side, so it's either side, but it's a very strong key currency as well, the Swiss franc, not to be overlooked. Many people overlook it or don't trade it simply because of what happened in 2015, or they don't see it as liquid, and it isn't perhaps as liquid as the top three, but it's still a key currency. For instance, when I'm looking at my 4-hour charts, I tend not to look at the Swiss franc, for instance, but on the daily charts, very much so. I'm a bit more of a question mark over Swiss franc in the intraday charts, but that's just the way my personal trading has developed. Okay. CAD, Aussie, and New Zealand, the key commodity currencies. Okay, everybody's probably aware of the dollar, of the CAD being an umbilical cord to the price of oil, as I've called it, and most people concentrate on this pair. What's changed recently, though, or dollar CAD, so tends to accumulate or appreciate as oil trades. So again, if you're an oil trade, you need to know the key news announcements. So there's 4 key news announcements each and every week about that affects the oil industry, regardless of what OPEC might say, or regardless of what some energy minister might say in Russia or Venezuela or Nigeria, which will obviously affect the oil price, all of them being major oil supplies. So the US oil inventories come out every Wednesday, 2:30 GMT, absolutely key. The night before Tuesday, the private API, this is the official inventories from the EIA, but the API is a private institution. On our Tuesday night, they come out with their inventories. I think yesterday was a bit of a drawdown, so oil's dipped a bit, so that causes oil to move quite significantly at these times when it needs to come out. Also on Friday now we now have the US rig count, so shale oil is now a significant sector of the greater oil market now as well. So what US oil, how many US oil rigs are out there affects the oil price, and therefore by default will affect the Canadian dollar. So again, you can structure, and again, I know lots of people that just trade oil and gold, and they structure their oil trading around these key events each week, so 4 major events, and it gives them enough opportunities to understand and get right into the oil market. They're very heavily researched into the energies and the oil, and they're also obviously they are interested in the tanker shipments, where they are in the world, where they're moving, what the particular prices are going on within different markets, and what different suppliers are charging their particular customers, all that sort of stuff. So trading oil itself is a huge industry just on its own, and the dollar CAD is the main way we can see the oil market. Aussie is a major commodity producer, so it's heavy commodities, so things like gold and coal, and in particular iron ore. Iron ore has been at record prices. Steel, the price of steel, for instance, is at a record high at the moment. Steel is the major producer is China. China's close to Australia, and the Asian is the major producer of steel now, and a major contributor to make steel is iron ore, and Australia is a major supplier of iron ore, so therefore the Aussie dollar has benefited from that over this year. And it's accrued quite well. It's coming down now, but it's with these high steel and iron ore prices, the Aussie dollars, I say, benefit. It's rolled over from these major highs at the moment, but a major export for Australia is iron ore. You can't actually trade iron ore directly, but it's, again, if you're looking at why did the Aussie dollar move like it did sometimes, one of the reasons can quite often be some commodities that's moved, not necessarily economic data that's come out of Australia. Obviously this morning there was a weak GDP figure, and that's spiked the Aussie dollar down this morning, and it's sort of recovered a wee bit since then, but and I'm actually took a long trade on the Aussie dollar yesterday. But anyway, so that's that sort of correlated thing. And then again, you owe it to yourself. If you're going to trade these markets, you really do owe it to yourself to dig around and get a bit of background. I know a lot of you out there are based in South Africa or the southern parts of southern Africa, and obviously commodities are absolutely vital to the economies of many of the southern African countries. Obviously, gold used to be the major export for South Africa, but now it's platinum and palladium. Again, both commodities that can be traded. Both will impact the local currencies. So look at some of the fluctuations in the dollar rand, the USD ZAR, can be attributed not necessarily to economic news or political news, which has been driving the pair obviously recently, but these commodity news, these commodities, mines closing down, mines opening up, new production coming on stream, can have a big effect on some currencies as well. So again, you owe it to yourself to do a little bit of background and understand why these things are doing what they're doing. And sometimes the technical analysis can get thrown out of the window if there's some big fundamental discovery in it, or a big platinum mine closes down, or those sort of things. So always one to watch. The other key currency that again often gets overlooked is the New Zealand dollar, but again, as I said, it's got the highest interest rate, so that's why it's a player. Very small country, New Zealand, 44 million people, but a significant Forex market. And the key currency, the key issue for New Zealand is the soft commodity currencies, and there's a thing called the General Dairy Trade data that's released twice a month typically, and that has a big effect on the New Zealand dollar. It's very strongly correlated to the Chinese economy. Again, 18% of all New Zealand exports go to China. In Australia, it accounts for something like 35%. So the impact of the Chinese economy is much more significant on the Aussie dollar than it is on the New Zealand dollar. But again, these two are quite closely correlated as well, Aussie, New Zealand. And again, I think we took a trade yesterday, long Aussie, short New Zealand. I think it was a long trade we take. So again, that's another correlation that's within their own small region there. But things like milk powder, agricultural products, any sort of agricultural products, whether it's meats, milk powder is a big export to China. And then, for instance, a couple of years ago when China took the ban on families having more than one child, the demand for milk powder rocketed, and the price leapt up just on the announcement, simply because more children mean more milk powder required for babies. So that was good for the New Zealand dollar. And it's all these sort of things. If you're trading particular currency, you get to find out, you get to stick to. So if you're starting out, if you only want to look at 5, 6 currencies, 3 or 4 currencies, these are the sort of things you owe it to yourself to get a little bit of background in them. So these are the commodity currencies. Oops, that's an old slide, isn't it? But what am I talking about? This. It's an old slide, but I say these are from last year, but you can see this time and time again. So although these charts are old, you can see this strong correlation. So here, 2016, last year, we were in a risk off. We had a strong yen and a strong gold in step. So as the yen came, the dollar came down and the yen went up, gold rallied as well. Obviously, dollar was under the pressure because it was on the either side of these. It was a corresponding side of these. So we got dollar yen going down, we got gold going up. Very clear correlation there. Some of them, don't break down. Same time frames, January to middle of May. I was supposed to put this back together either a year ago, and nothing's changed. We could bring up a similar chart of this year, and we've had a very similar sort of pattern. We've had, correlation pattern as as the yen and the gold are very closely correlated positively. Dollar CAD here, this is a 4-hour chart. This happened to be pulled out June, but again you can see a very clear correlation. Oil going down, dollar CAD going up. This hits the, there you go, that's why I've used this. So it was the 16th of June last year. We bottomed here. 16th of June last year we topped here. So in direct correlation. So oil, this happens to be UK oil, dollar CAD, very closely correlated to the price of oil and move in sync, tend to move in sync, but not all the time. This one's a very, very clear link, as you can see here. It's broke as this chart closed, it broke a clear moving average. As this chart closed, it broke another clear moving average, but in the exact opposite direction. So strong correlation between dollar CAD and oil price. So sometimes it's not as strong as it clearly demonstrated there on that 4-hour chart. But again, you can do this on any time frames, and you'll see these correlations sticking together. Strong positive correlation, Aussie and gold here again. So we got Aussie, perhaps not as strong. So we got gold rallying to a peak on the 19th of April there. 19th of April we had a string similar positive correlation. Absolutely kept going there, didn't it? A few days after. Actually the point height was there, wasn't it, as it rolled over. So here, that's another good example, isn't it? Here we've got, let me just bring up the pointer. You can see how sometimes one gets ahead of the other. So here our highlight was, was here the 19th, but here, so Aussie started to roll over before gold didn't peak till we got a bit later in the month, which is probably a few days later, wasn't it? So this was 19th, this was into May, so a few weeks later before gold rolled over. So Aussie here was a bit of a heads up of the gold market topping out, but gold kept going before it rolled over. But again, clear down, and again the bottom was here, was about May, and again the bottoms are more in sync there, wasn't it? So 17th, this is about beginning of June there before it turned around, similar. So it's turned around, both had the big the big up candle was on the same day there, June, whatever date that was, as gold went up and the Aussie dollar went up. So strong correlation, but not completely in sync there. So that might have been a bit of a heads up that gold was going to top out at some point as well. Okay, so strong positive correlation there between gold and the Aussie dollar. Again, I've just talked about gold being a key export for South Africa. Still not perhaps as significant as it was. It's a bit of a messy chart, isn't it? But again, it's from this is the daily. This is daily. This is the dollar against the rand, and the gold chart here. So here we've got moving. This is what date here I've highlighted here. This is the 16th of 9th of June. 9th of June's where on here? 9th of June's here, isn't it? Whoops. Here. So it doesn't always correlate. So we've had a movement down to the 9th. Here we had a movement down, and it's turned around first. So here the gold has turned around. So what am I talking about? Yes, it kept going down, even though so the gold had turned around before the rand turned around. So the up movement, movement down, but not as significant. So again, not correlated all the time. Something else might come in, so don't hang your hat on it completely. Okay, but you can pull all these up for yourself as well. There's lots of options. Here I was talking about the inverse correlation between the cable rate and the dollar index. Inverse correlation, but not always, as I put on here, like most of these, not always. But again, you can see a clear movement down. Here we've got a clear movement up. Where's our peak? Our peak there was, what day is that? That's looking like the middle of March. And here, actually that's quite well correlated, isn't it? The middle of March. So we've got a clear cable going down, dollar index going up, turn around, up we go, down we go, and the dollar index kept going down to about the end of March here. And actually, no, that's actually quite well correlated, isn't it? So we got that same 28th again there. No, there was a bit of a gap here. So as we got the gap here on the market, we got this moving down. So there was a few days delayed there, a few days difference. So this dollar index kept going down and gapped all the way down to just before the 28th. Here we got up and got up, but moved ahead. So the cable was ahead of the dollar index move there, and then we've gone sort of up and down a bit. Here we've actually moved up quite aggressively, dollar index. So that's a dollar rising. So again, these correlations don't last forever and all the time, but they can be quite useful and help you to keep you on the right side of any particular move. So that's the pound cable, pound USD against the dollar index. So I'll pull those two up as well. And again, look for them yourself. You might think of a local currency that you think, oh well, my local currency, wherever you are, in Indonesia or Malaysia, might be correlate. We do produce oil there. How is it correlated to the oil price? And again, see if you can take that, because sometimes it can be a hedge for, or you can double up on your trading opportunities. Depends on, again, how you want to play it. So either as a hedge or as doubling the opportunities that's available to you. Now, this is one I talked about at the beginning. Remember, we talked about New Zealand dollar and the Swiss franc being at the extremes of the interest rate decision. So for most of 2016, we were quite it's quite a big channel, but we were bounded, okay. And when I last put these charts together, we were looking at looking into 17. Were we looking to break out? So here we were at 68.32, and I think I touched on it earlier, didn't we? We were kept within the bounds of, we couldn't break 68, but it looked like it was breaking up here as we put this together, and the low was down here at 64.50 sort of zone, just nicely sideways, but trending upwards. We'd broken over the 20 period here, was the last time back in May, and we seem to be moving out. So this is what I say, this is when I last put this, last had these charts up, but what's happened since then? Well, here we are into 2017, and through the rest of that year we did rally indeed. Remember, we were at 68. Oh, I can't actually. Remember, we were down here at 68 back in 2000, over here off the chart here, and we rallied all the way up to 72, 73 nearly here. Oops. And since then, since the noise has come out that the New Zealand government were looking to, there was a New Zealand election earlier this year, wasn't there? And the New Zealand dollar had got too strong, and the RBNZ was sort of looking to try and weaken it. We've had a general trend down. So here from the summer on this daily chart, the New Zealand Swiss has narrowed. We've been in a downtrend, quite a strong downtrend, steady downtrend, lower highs, lower lows here, and we've moved down. We've bottomed all the way back to 67.05, so we're below where we were this time last year. And let's just go back. So 67, we were back down into this congestion zone again. So, and again, that's all to do, that particular move is all to do with these interest rates and the expectation of interest rates coming down in New Zealand, and that's so the differential is starting to narrow on these two. So again, I could bring up lots and lots of different ones, but these are the correlations that are out there all the time. Are there any others you would like me to actually have a look at while we're here, and bring up some live charts and see if there is see correlations that you are interested in or look at before I go on to the next little stage, little brief rundown on the bond market before we finish. No? Okay, let's crack on. So bonds, the other area that we've just introduced bond trading, and they're very significant. It's a significant part of the financial market, and significant because you hear them, whatever piece you'll read, or if you're watching Bloomberg or CNBC or you're watching Reuters or reading anything, it's all about, they talk about yield all the time, the yield curve flattening. That's what the central bank are looking at before. But bonds are simple IOUs over a fixed term. They're issued by governments and big companies, and it carries a regular payment, or coupon as they call it sometimes as well. You can take it until the bond matures. So these really long bonds that governments are now issuing. Typically it's a 10-year is what we look at. 2 years a very short one, but governments now are issuing 30, 50, and I even saw last week the University of Oxford have issued a 100-year bond. So it doesn't mature for 100 years, so you can't get your money back for 100 years, but they guarantee to pay you regular payments twice a year. So it's a bond is basically the buyer, you taking it, you're basically lending money to a government or to a big institution like Oxford University over a fixed term, and that's why they're called fixed income, and it pays regular interest payment on a fixed term of the contract, so twice a year. For 30 years or for 2 years or for 3 years or whatever it is, 10 years typically is what's paid. They're known as different things in different parts of the world. And in the US they call T-bonds or T-bills. In the UK they call gilts. They're bunds in Germany. So when you hear about talking about the Euro bund, that's what they're talking about. I've started trading that as well. It's a bit gappy, but it's interesting. Other parts of Europe, OATs in France and BTPs in Italy, and the JGBs, the Japanese government bonds, are the other key ones. So it's US T-bills or bonds, UK gilts, Euro bunds as they're known, issued by Germany, and the JGBs. They expire at specific quarterly contracts 4 times a year on specific dates. So again, be aware of those. But they're very fundamental, and they're issued by governments all the time to generate income for themselves. So again, you'll see that during the day. You'll see that on the economic calendar if some bills are being issued, and it's a significant part of the market, of the financial market. Low risk, long term, tends to be less volatile, much less volatile than equities or commodities or certainly Forex, but can still be quite volatile within itself as well. So say bought by big players, part of a balanced portfolio. It's fixed income, lower, much lower than compared to any dividend you might get on buying a stock. So if you bought a big stock, that usually the dividend will be much higher than on a bond, but the risk is much higher as well. So it's all about balancing your portfolio. So I'll tell you what, that's probably enough on bonds. I won't go into too much detail on bonds, but anyway, they're issued, they're available, and they're a significant part of the market. And again, you can find the different rates, but as you say, typically 10-year bonds, different yields for different parts of the country. So depending on the risk of a country, the yield will be significant. So look, in the States it's very low risk, 1.6% the yield, whereas in Brazil the yield is 12% because they're desperate to get people to invest in their country, so they have to offer big yield. So again, in Europe, you see we got, here when I put this together, it was 3% up in Portugal, 0.0% down in Germany. Very low risk in Germany, very low return I should say in Germany because it's very low risk. Much higher risk in Portugal, so higher return. So it's all about the balanced portfolio. Here, Greece was up at 7.75%. But 30 years, 50 years, and I say even up to 100 years. It's absolutely crazy now that some of these bonds are going out for many years, and for governments to issue 50-year bonds and to have such a low yield for such a long time is crazy, really. And that's what the market is worrying about when you see all the guys on the TV and on, say, CNBC and Bloomberg talking about the bond yield. It's that's starting to sort of spike up the markets, just like the stock markets are getting these record highs. So the bond yield is starting to spook some parts of the market. Arthur, I hope you can still hear me. Arthur's putting the audio's got poor. But I hope not. Anyway, that's about it, really. I don't really want to talk much more. It's all about understanding the markets that you're trading in, and principally understanding yourself first as a trader. But if you're going to start looking at correlation, it's quite important, and it can have a quite great effect on the currency you're trading. So do a little bit of background on what you're trading or why it may move. Tomorrow, Kay will be talking about scalping. I know a lot of you are very interested in scalping. It's short term, it's quick, it's fast, it's quite stressful. Well, it's very stressful, and if you're not designed to deal with it psychologically or physiologically, it can be quite very stressful indeed. But Kay goes some very simple strategies tomorrow. Live analysis every Tuesday, the 19th and the 12th next week. Andrew's got a really good little presentation on pivot points, intraday pivot point trading. I'm really looking forward to that. That's pivot points can be quite strong and quite often hit quite a lot, so there can be some strong support and resistance levels as well. Kay's talking about crossovers, moving average crossovers. I'll be talking about some alternative indicators that people tend not to use, but as valid as some of the more popular ones, to be honest, on the 20th. And then the last week of the year, Andrea will do a review of the year. Kay will be talking about, the key thing about getting rid of emotion control, and also looking at support and resistance as well. So do join us then if you can. Download the app if you've got it. If you haven't got it, it's well worth having. News, our analysis, prices, all on there as well. By book list, I didn't run through this very much yesterday, but this is important. I always think it's important. I say this every webinar. But Edwin Laver's Reminiscences of Stock Operator, the most important trading book ever written in my view. Nearly 94 years old, nearly 100 years old. And the other key one on here, both of them now, these two here in black, you can download them as PDFs. So Google them or search them on your search engine. Trading in the Zone by Mark Douglas, all about trading psychology. Very, very powerful book. Jack Schwager, these Market Wizards books, interviews with 50 or 60 interviews with some of the world's top traders. And when I say top traders, I mean these guys turn thousands into billions, literally. They're not made up. These are real guys back in the 80s and 90s. He's got 2 more books since then. He's interviewed fund managers as well. A lot of these guys are quite reluctant. They don't want a lot of publicity. Some of the most powerful hedge fund managers don't like publicity, but they're, Jack Schwager managed to get them to talk, and it's all about the simple things we talk about: patience, discipline, cutting your losses, all this boring stuff. But this is what these super guys, these super traders, that's how successful they are, and that's why they're successful. So it's the basics you've got to get right every time. Elder and Van Tharp, again, good teachers of trade for traders, both commodities and equities. Michael Lewis writes really very lucidly about the stock markets. All the way back again in the early 80s, he worked on Wall Street, full-time author now. Big Short about the financial crash, Flash Boys all about the HFT market. Great books. Lies Poker is one of his originals. Boomerang was another one. His book he's produced this year, The Undoing Project, it's a great big slice of it is about the financial markets, but it's principally the story of 2 world-class psychologists that created behavioral economics, and how it affects everything that touches us now, everything big data to the financial markets to medicine to it's a fascinating book. My book of the year, if you want to buy one book this year or read over the holidays, The Undoing Project by Michael Lewis, fascinating. Nassim Nicholas Taleb is a options trader. He's a professor of probability. It's all about probabilities. Fascinating 2 books. Fooled by Randomness is the first one I read, and then the very famous Black Swan. That Black Swan doesn't exist, can't happen. The probability says, well, it can. Do things long enough, it will happen. If you're new to Forex, read Anna Cooling's Forex for Beginners, a great introduction book. So thank you for your time. I hope that was useful. Follow me at webinars at hotforex.com, or email is there. All our analysis is up at the analysis page. All the education is on there as well. So get yourself educated. It's all about knowing yourself, really. And follow me at Stuart Hot Forex Cowell on Facebook. That's where I put up the news. I put up some positions we've taken, some trades we've taken, and anything that's going to affect the market. Pound very much in play today. Those of you trading very much under the cosh at the moment. So we'll see how that transpires over the next few days as well. Obviously NFP this week highlight, and later on today we've got the non-farm, the ADP numbers as well, which will have a big impact on NFP. So any final questions before I go? If I haven't bored you silly? No? Okay, thank you very much for your time. I will see you all on Tuesday for live analysis, and on Friday I'll be doing a live Facebook for the NFP as well. So see you then. Take care. Bye bye.